In 2025, the U.S. cryptocurrency market experienced a significant resurgence, with investments reaching $7.5 billion year-to-date, highlighting a renewed confidence among institutional and retail investors. This growth is largely attributed to favorable market conditions and an evolving regulatory environment that has become more accommodating to digital assets. A notable highlight is the substantial inflow of $785 million into U.S.-based crypto investment products in just 1 week, indicating a strong recovery from the earlier $7 billion sell-off. The U.S. led the global inflow, followed by Germany and Hong Kong, with Bitcoin, BTC, maintaining its dominance, trading above $100,000 and nearing its all-time high. Bitcoin's impressive performance is supported by the approval of Bitcoin ETFs and increased institutional investments, with financial giants like JPMorgan Chase now permitting clients to purchase Bitcoin. Analysts predict that Bitcoin could reach up to $200,000 by the end of 2025, driven by its perception as a hedge against inflation and its capped supply. Meanwhile, Ethereum, ETH, has completed its Spectra upgrade, enhancing transaction speed and reducing costs. Although it still faces competition from faster alternatives like Solana. The inclusion of Coinbase Global in the S&P 500 index further underscores the cryptocurrency industry's integration into mainstream finance, reflecting a maturing market poised for continued growth.
Nike Inc., a leading sportswear company, has initiated layoffs in its technology division as part of a strategic overhaul led by CEO Elliott Hill. This move is part of a broader restructuring effort aimed at streamlining operations and outsourcing certain technological functions to third-party vendors. The decision comes amid a challenging period for Nike, which has seen its stock decline by 18% year-to-date as of May 19, 2025, in stark contrast to the S&P 500's 1.4% gain. The layoffs, which affect enterprise and corporate strategy teams, are intended to help the company regain its competitive edge against emerging rivals like On Holding AG and Hoka, which have been capturing market share with performance-driven products. The restructuring is a response to both internal challenges and broader economic pressures facing the sportswear industry in 2025, including tariff uncertainties and shifting consumer preferences. While Nike experienced a temporary stock surge following a U.S.-China tariff reduction agreement, investor concerns about long-term growth prospects remain. Analysts suggest that the company's focus on cost efficiencies through outsourcing could free up capital for innovation, but may also risk losing control over its digital ecosystem. The success of Nike's turnaround strategy will largely depend on its ability to balance these cost-cutting measures with strategic investments in product development and digital innovation as it navigates a competitive and volatile market landscape.
The article highlights the significance of domestic revenue generation for U.S. companies amidst global trade tensions and tariff uncertainties. It notes that while many American companies like ExxonMobil and McDonald's derive substantial revenue from international markets, this exposure could pose risks due to potential cost increases from tariffs. Conversely, a weaker dollar might benefit these companies by making their offerings more competitive abroad. In contrast, firms with a primarily domestic focus, such as Verizon Communications, Kroger, and United Health Group, might offer more stable investment opportunities in this climate. Verizon Communications is presented as an attractive investment for income seekers, boasting a dividend yield of 6.4%. Despite its stock's modest growth and substantial debt, Verizon's consistent cash flow supports its dividends, making it a viable option for those prioritizing income. Kroger, with its extensive network of stores across the U.S., is positioned as a defensive stock, offering essential goods that remain in demand even during economic downturns. Although its profit margins are slim, its volume-driven business model and consistent dividend growth make it appealing for long-term investors. United Health Group, despite recent challenges, including a Department of Justice investigation and a CEO departure, is highlighted as a potential turnaround opportunity. Its stock has declined significantly, creating a potential entry point for investors who believe in its recovery prospects. The company's forward P/E ratio is notably low compared to its historical average, suggesting undervaluation. These companies, with their robust domestic operations, provide investment options for those concerned about the impact of international trade dynamics on revenue and profitability.
Dell Technologies, in collaboration with NVIDIA, has unveiled significant enhancements to their AI Factory initiative, aimed at streamlining enterprise AI adoption and scaling. Announced during Dell Technologies World 2025, the updates include advanced infrastructure, comprehensive enterprise AI solutions, and new managed services designed to tackle deployment challenges such as cost, complexity, and data security. Central to this upgrade are the new Dell PowerEdge servers, which integrate NVIDIA's cutting-edge GPUs and AI technology, promising up to 4 times faster training for large language models, LLMs, and significantly improved AI inference output and throughput. These innovations reflect Dell's strategic focus on AI, with 75% of organizations deeming AI crucial to their business strategy, despite facing implementation hurdles. The partnership leverages NVIDIA's expertise in AI hardware and software, including their Blackwell GPUs and Spectrum-X Ethernet platform, to deliver an integrated end-to-end AI solution. This collaboration aims to simplify AI deployment across industries such as healthcare, finance, and manufacturing by providing enhanced compute, networking, and storage capabilities. The introduction of managed services, including 24/7 monitoring and version control, further supports enterprises by alleviating resource constraints and accelerating operational outcomes. With Dell's AI Factory now supporting NVIDIA's validated enterprise AI factory design, the initiative underscores the company's commitment to democratizing AI and enabling businesses to harness its full potential efficiently.
The latest report from Silicon Valley Bank, SVB, highlights a significant shift in venture capital funding towards artificial intelligence, AI, with AI-focused funds accounting for approximately 40% of the money raised by U.S. startups last year, up from 10% in 2021. This surge is largely driven by capital-intensive companies such as OpenAI and Anthropic, which require substantial investment to sustain their growth. However, despite the influx of capital, the IPO market remains subdued, leading to the emergence of zombicorns, startups with poor revenue growth and unit economics struggling to secure additional funding. The report underscores that AI companies represented 45% of U.S. venture investment in enterprise software, a significant increase from 9% in 2022. Notably, AI megadeals, defined as funding rounds of $100 million or more, constituted about half of the total capital in this category. While AI investments are booming, the broader market is witnessing stagnation, with investments outside AI remaining flat. The lack of exit opportunities, exacerbated by economic uncertainties and rising interest rates since late 2021, has constrained returns for venture capitalists, leaving limited resources for startups outside the AI domain. As a result, the venture capital landscape is increasingly polarized, with AI startups attracting substantial funding while others face financial challenges.
Warren Buffett's recent divestment from New Holdings, a digital bank headquartered in Brazil, has sparked interest and speculation within the financial community. Despite Berkshire Hathaway's exit, New Holdings has demonstrated robust performance, with its stock surging over 25% in 2025. The fintech company, which operates across Brazil, Mexico, and Colombia, boasts a significant customer base and continues to expand rapidly. In Brazil, it serves 59% of the adult population, and in Mexico, its customer base grew by 70% year-over-year in the first quarter. New's strategy of leveraging digital infrastructure to minimize costs and enhance customer engagement has resulted in a 74% increase in net income and a 40% rise in revenue year-over-year in the first quarter. The decision to sell New Holdings shares aligns with Buffett's broader trend of being a net seller of stocks over the past 10 quarters, including a partial sale of Apple stock. While the rationale behind Berkshire's complete exit from New remains unclear, it could be attributed to Buffett's historical aversion to IPOs and tech stocks, potentially indicating that the initial investment was driven by his managers, Todd Combs and Ted Weschler. Despite this, New Holdings continues to capitalize on its low-cost operations and high returns, driven by interest earned on its credit portfolio and efficient use of technology. With plans for international expansion and a strong foothold in its current markets, New Holdings is well-positioned to continue its growth trajectory, offering promising prospects for long-term investors.
The International Labor Organization, ILO, has released a report highlighting that jobs traditionally held by women are more susceptible to the transformative effects of artificial intelligence, AI, compared to those held by men, particularly in high-income countries. The report indicates that 9.6% of female-dominated roles are poised for transformation due to AI, compared to 3.5% of male-dominated roles. This shift is primarily attributed to AI's increasing capability to handle administrative and clerical tasks, such as secretarial work, which are predominantly occupied by women. The ILO emphasizes that while AI may not entirely automate these roles, it is likely to significantly alter the nature of the tasks involved. The report also notes that industries such as media, software, and finance are at the forefront of this AI-driven change, reflecting the technology's growing influence across various sectors. The ILO urges governments, employers, and workers' organizations to proactively consider how AI can be harnessed to enhance productivity and improve job quality. Rather than merely replacing human labor, this call to action underscores the need for strategic planning to ensure that the integration of AI into the workforce is beneficial and equitable, particularly in mitigating the disproportionate impact on female employment.
The Indian stock market experienced a notable decline, with the Nifty 50 and Sensex indices both falling over 1% after previously trading within a narrow range. This downturn follows a 4% rise in the previous week, leading to profit-taking as investors reassess valuations near October peaks. Concerns over muted earnings reports in the March quarter and external factors, such as Moody's downgrade of the U.S. sovereign rating and renewed global trade tensions, have contributed to the bearish sentiment. Despite these challenges, the market outlook remains cautiously optimistic, buoyed by continued, albeit reduced, foreign investor inflows. Market analysts suggest that the Indian stock market is entering a consolidation phase, with high valuations potentially capping further gains. Institutional selling has been observed on market rallies, yet mutual funds, holding substantial cash reserves, are likely to buy on dips, supporting the market. Technical analysis from domestic brokerage Way2Wealth indicates that the Nifty remains bullish overall, trading above key moving averages. Investors are advised to adopt a strategy of buying on dips, particularly in the 24,900 to 24,950 support zone, while being cautious of any close below 24,650, which may necessitate a reevaluation of the market outlook.
Dollar General is at the center of a security breach after card skimming devices were discovered at 2 of its stores in Iowa. These devices, which are used to illegally capture credit and debit card information, were found at the George and Rock Rapids locations. This incident has prompted local law enforcement to initiate an investigation, including reviewing CCTV footage to identify the perpetrators and determine the extent of the breach. Customers who have recently shopped at these locations are being urged to monitor their bank accounts for any unauthorized transactions. The discovery of these skimmers highlights a growing concern over retail security, especially in large chains like Dollar General, which operates nearly 20,000 stores across the U.S. and Mexico. The ease with which skimming devices can be acquired and installed poses a significant risk to consumers and businesses alike. Such incidents can lead to financial losses for both customers and retailers, as well as damage to brand reputation. Financial institutions and retailers are advised to enhance security measures and educate customers on identifying potential fraud. This incident underscores the importance of vigilance in financial transactions, especially in high-traffic retail environments. As investigations continue, the potential impact on Dollar General's operations and consumer trust remains uncertain. The broader implication of such fraudulent activities could lead to increased regulatory scrutiny and a push for more robust security technologies in the retail sector.
The financial landscape is witnessing a pivotal shift as vertical farming emerges as a potential solution to Canada's food security challenges amid tariffs and climate change. Avery Family Farms in Okanagan Falls, BC, exemplifies this trend, utilizing advanced agritech to produce thousands of heads of lettuce daily within a controlled indoor environment. This initiative is part of a broader movement to reduce dependency on imported produce, particularly from U.S. states like California and Arizona, which face increasing environmental constraints. the farm's development underscores the strategic importance of local food production in mitigating the risks associated with geopolitical tensions and supply chain disruptions, as highlighted by the surge in demand following tariff announcements by former U.S. President Donald Trump. Despite its promise, the vertical farming model grapples with significant economic challenges. High operational costs, driven by energy-intensive climate control systems and expensive labor, have led to precarious financial viability for many players in the industry. This is evidenced by the high-profile bankruptcies of U.S. vertical farming companies such as Plenty and Bowery Farming. In Canada, companies like Grower and Goodleaf are adopting more cautious expansion strategies, emphasizing the need for substantial capital investment and strategic support to achieve scalability. The Canadian government's economic plan, advocated by Prime Minister Mark Carney, aims to bolster this sector through targeted support for greenhouses and vertical farms, framing it as a crucial component of economic sovereignty and resilience against inflation and climate change impacts. The vertical farming sector's trajectory in Canada highlights the intersection of science, policy, and economic strategy. Experts like Evan Fraser from the Arrell Food Institute stress the necessity of robust regulatory frameworks and investment to navigate the industry's inherent risks. As Canada seeks to fortify its agri-food sector, the challenge lies in avoiding the pitfalls of past tech sector missteps, ensuring that innovation leads to broad-based economic benefits rather than concentrated power. The developments at Avery Family Farms offer a glimpse into a potential future for Canadian agriculture, contingent on strategic policy alignment and sustained investment.